But we got to start with what's going on, not just with what we heard from Jay Powell yesterday, but what we're seeing in the markets in reaction to it, as well as reaction to the economic data. For that, we bring in our Brian Cheung, who of course covers the Fed, and our Jared Blickery, who is watching the markets. Brian, want to start with you. What changed yesterday in terms of what we heard from the Fed?
Well, first of all, immediately there were no policy changes yesterday. The Fed opted to hold interest rates at near zero, but we got a lot of messaging about where the Fed could go later this year. And it all came from the Fed chairman's press conference when Jay Powell said that the Federal Open Market Committee is, quote, of a mind to start hiking interest rates as soon as their next meeting in mid-March. Again, you never really hear the Fed chair say something is going to happen down the line beyond, what we heard yesterday. So the type of detail that we're getting strongly suggests that the Fed is very serious about wanting to start raising interest rates to get ahead of high inflationary pressures. And we also got more commentary on the Federal Reserve's nearly $9 trillion balance sheet when they released a principles document that details how they might go about actually actively allowing the balance sheet to start to shrink later on this year. Keep in mind, right now, it's still increasing. The process of adding assets to its holdings is going to stop in mid-March. That's a reason why the Fed says that March rate hike is on the table. But the details say they will want to significantly reduce the balance sheet. So maybe the Fed even being a little bit more hawkish on that front. But what's interesting was in totality, it remained unclear exactly how the Fed would want to group both of those things, interest rate hikes and a slowing down of the Fed balance sheet. I asked the Fed chairman himself if he would describe this process as gradual. Take a listen to his response yesterday.
I don't think it's possible to say exactly how this is going to go, and we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much, much stronger than it was, and growth is above trend even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy.
It's really the Fed chairman saying he doesn't want to describe it one way or another, but it is interesting to see him want to give himself the optionality to do essentially whatever they want to do and maybe hike interest rates faster or shrink the balance sheet faster than they anticipate. But either way, they want to give themselves the flexibility as they continue to watch inflationary numbers. If you take a look at Fed funds futures markets, a lot of repricing happening yesterday. The expectation, again, is still prevailingly for a 25 basis point hike in the next meeting in mid-March, 88%. But take a look at the 12% of people that are calling for a 50 basis point hike in that meeting. Certainly something to watch about 6 weeks from now, Julie.
And sort of as if to to emphasize the point he made about this time being different, we got GDP numbers this morning that showed that 6.9% growth, really pretty hot growth, I think we can say, in the fourth quarter. Some of this had to do with inventories. Can you walk us through what happened in the fourth quarter in terms of growth?
Yeah, well, certainly it seems like maybe some of the alleviating of the supply chain pressures were a reason why we did get a little bit higher of a print on GDP for the fourth quarter compared to the third quarter. When you look at that 6.9% print that we had gotten from the Bureau of Economic Analysis as a first read on fourth quarter economic activity last year. Again, that's compared to 2.3% in the third quarter. And the BEA was saying this is because of an upturn in exports, an acceleration in inventory investment, as well as consumer spending. The inventory investment, again, could be because the supply chain issues with the port bottlenecks that we had seen in the third quarter appeared to alleviate just a little bit between the third and fourth quarter. They're still kind of prevalent, but maybe less so than in the third quarter, which is a reason why we're starting to see that weigh on GDP. But we have to keep in mind that number that we got, 6.9%, is an annualized quarterly reading. It's a bit confusing. I don't really like it all that much. But basically, it's if you take the pace of what the economy grew in the fourth quarter, you extrapolated it across 4 quarters, it would be 6.9%. But it's not like the economy grew 6.9% in 1 quarter. But obviously, now that we have a full read on what happened over the course of 2021, if you just measure where GDP was in the beginning of the year last year and then at the end of last year, the economy grew by 5.7%. That's really the better reading, the better number to look at. And that is the fastest number that we've seen in terms of economic growth here in the United States since 1984, kind of comparable to prices, for example, going up at the highest pace since the early 80s. So that is interesting, as well as the personal savings number, which I was looking at, $1.34 trillion in the fourth quarter. That's a market slowdown from the $1.72 trillion in the third quarter. Personal savings rate going down from 9.5% in the third quarter to 7.4% in the fourth quarter. That's showing perhaps some of that buffer that people have been using to spend and maybe drive inflation could be decreasing between the third and the fourth quarter. But of course, all of this is weighing on the data when it comes to the markets. I was looking at the 10-year yesterday, tilting up a little bit higher, but not nearly as high as the 2-year. So that curve really getting a little bit more flat. But I know someone who really loves to talk about rates. And of course, that's Yahoo Finance's Jared Blakely with all of the market updates. Jared, what are you watching this morning?
Well, with that kind of intro, Brian, I really got to excel from here. And by the way, I echo your sentiments on GDP. I think the U.S. is the only country in the world, or one of the few, that calculates it that way. But I want to go to the Wi-Fi Interactive and just kind of chart the price action from yesterday, because, by the way, Brian, you were moving the markets as well. This is the S&P 500 futures contract. And here we have, this is a 2-day view. So I just want to outline what happened yesterday. Yesterday, we kind of jolted up overnight, and we were able to maintain those gains during the day. Here's where we got the FOMC announcement. We jolted up here, and then when Powell took the lectern, as I like to call it, it was down, down, down in a series of steps here. And at the very end, and by the way, this was all on the inflation talk and also about the balance sheet talk. But at the end, Brian, when you asked that question, I watched the S&P 500 go to new session lows. Overnight, guess what? We got a little bit of a bounce, but that was sold off again. So let me put up a longer term chart just so we can kind of get our bearings here. Over the last 4 sessions, it has been extremely choppy, but we have essentially gone nowhere. You see this range that I'm outlining in the screen here. So until this range is broken, not a lot to do. I'm going to take a look at the NASDAQ. That's a pretty similar situation, and also the Dow futures. But I also want to take a look at some of the other markets. Here's what gold futures have done in response. The hawkish tone by the Fed definitely not walked back. I posited yesterday, if Powell really wanted to save stocks, and he wanted to see a huge rally, he had the power to do that. And that's simply not what happened. Want to take a look at the bond market? I was watching that too yesterday, and we see that the 10-year T-note yield is off about 1 basis point, but we did get another thrust up yesterday on that pivot. So also want to check out the dollar here, because that has been on the rise recently. And you can see we have definitely broken out of the recent range. Let me put a longer term chart here. This is a 1-year chart. And this has important implications for a lot of asset classes, not the least of which is Bitcoin. And let's take a look at that. If you want to see if Bitcoin has a correlated behavior with stocks, just check out the 2-day price action. Hard to see here yesterday, but we did get a lot of movement off of that FOMC statement. Very similar, and this is still the US dollar. See if we can go back here and get my Bitcoin chart. There we go. So this is Bitcoin on a 2-day basis, and you can see that we definitely had some price movement there. Before I go, just got a few seconds here. Want to check out the sector action. Energy in the lead once again. We've seen that story this year, but importantly, tech also in the lead. So interesting leadership here. Maybe we have a risk-on day, but we'll have to see, guys.
Yeah, and as you talk about that energy movement, we have crude oil prices, which were really spiking yesterday. They're not seeing as much movement this morning, but that's something to continue to watch. You guys, I've been watching all of the reaction and commentary around the Fed, and I was checking out Mohamed El-Arian's piece for Bloomberg. He has been pretty critical of the Fed being behind the ball pretty consistently throughout all of this time, and he said that the Fed sort of had mixed messages here. He thinks that they should stop purchasing more assets for the balance sheet right away and be a little bit more clear on interest rates. Saz, I know you've been looking through a lot of the feedback too. I'm curious what stood out to you about the sort of reaction here.
Yeah, one reaction that caught my attention was Scott Minerd, Julie, friend of the show. He's been on a good number of times. He tweeted out yesterday, and I think just summarizing what he had to say, that investors should be cautious coming off of that, what is turning out to be a hawkish Fed meeting in many respects. And then we have Deutsche Bank's Matt Luzetti, who in many respects has been ahead of the curve of predicting a potentially higher pace of interest rate increases. He's now this morning saying, hey, we are no longer looking for 4 rate hikes this year. We're at 5 rate hikes this year. And I've seen some chatter also out there on the Twitter sphere of people looking for 6 to 7 rate hikes this year. I'm surprised we're not seeing more pressure here in the pre-market off of these rate increases or these calls from higher rate
increases. Minard even mentioning deflation, by the way, this year, and he's not the only one.
Yeah, and I think that when we talk about, though, directionally, we know that even though there is perhaps the other side of the risk that no one was really talking about yesterday, that maybe inflation does end up coming down lower than the Fed expects as they continue to rise upwards their expectations. Maybe that makes the Fed a little bit slower with regards to their tightening process. But I think really at the end of the day, Brian Sozzi was shouting on Matt Luzetti. I mean, the title of his note, I think, captures it quite well. Fed be nimble, Fed be quick. A little bit of a joke there, but the word nimble was used many times, including in his answer to me yesterday with regards to how they're not only going to approach any sort of increase in the interest rate, but also in the way that they'll approach their balance sheet slowdown as well. They could do that faster. They could do that slower. I think the way that Fed Chairman Jay Powell described it was we can really go whenever. The language in the statement was vague enough that they can be extremely flexible on that front. That uncertainty is a reason perhaps for why markets are getting volatile, but it's the optionality that the Fed needs with the uncertainty around where inflation is going to go this year.
What's bothersome here, and I'll just add very quickly, but I'm starting to get concerned on what these rate hikes, when they eventually come, if they will have an impact on inflation immediately. We're right in the middle of earnings season, and so many companies are calling out high levels of inflation, input cost inflation, not just for the fourth quarter, but for the balance of the year. And they are calling that out in large part because of these supply chain disruptions because of the pandemic. Rate hikes don't cure that. They just don't.
They don't. And so then if the supply chain gets better and you've got rate hikes, maybe inflation will come down more quickly. We shall see. Nimble is the new data dependent is how I'm seeing it. Thanks so much, guys. Brian Cheung, Jared Blickery, great team coverage here on that big Fed discussion yesterday.